I'm Angeline Ong, and welcome to Beat the Street, the show that gives you all the tradable news and data you need ahead of the Wall Street Open. Coming up, a bank's bonanza. Goldman Sachs and Bank of America report. We'll get more on that with Jeremy Naylor in just a moment. Results. There are other results on deck as well. Johnson & Johnson, Lockheed Martin, United Airlines also hand in their report cards. And of course, investors continue to eye the Middle East tensions and data as well. Of course, amid those earnings, we're waiting on US retail sales and factory output data. Good afternoon. Now, not long now before Wall Street starts trading, before I show you what the markets are up to, let's just have a quick look to see if the retail number is out, and it is. We were looking out for a month-on-month reading of 0.3%, and it came in slightly higher than anticipated, 0.7%. And excluding, if you strip out autos, that figure was also higher at 0.6%. We were looking out for 0.2%. Just looking at Wall Street now on the IG platform to see if there's been any sort of reaction. It's just ticked slightly lower, but not by a lot. Let's have a look at the volatility index as well. Pretty much similar to what it was before. Before that retail sales figure, it was around the 18 mark. It's now 18.38. Let's have a look at the dollar as well to see if there's been somewhat of a reaction there. The dollar was at around 105.84. And it's now 106.04. So quite a bit of a tick up there. Now, as I mentioned earlier, it's also huge in terms of earnings, especially in the banks sector. Jeremy Naylor has been digesting the results from Goldman Sachs and Bank of America for us. Jerry, what are the top lines?
Well, the top lines are, it's pretty good, actually. Goldman Sachs posting third quarter profit and revenue that exceeded analyst estimates on stronger than expected trading revenue. Earnings per share coming in at $5.47. We've been looking for $5.31. So that was better than the comparables. Revenue also better than expected, $11.82 billion. We've been looking for something like around about $11.2 billion. Among its big banking peers, Goldman Sachs is, I think, possibly the most reliant on investment banking and trading revenue. In other words, it doesn't have that spread that other banks have got. So third quarter commodity sales and trading revenue, $3.38 billion. Now, we've been looking for $2.9 billion. So that's smashed the park. There's been a move under the chief executive, David Solomon, to diversify its revenue stream, an ill-fated move into retail banking, which produced the Marcus accounts, which are still standout accounts, but it's no longer run or organized by Goldman Sachs, and then growing into asset and wealth management. But it is Wall Street that powers the company. Let's take a look at the share price chart, because this is part of what we're looking at here. It's an all-session stock. All session starts at 9 o'clock in the morning UK time, and we are trading through this number until Wall Street gets underway. In fact, you can trade all sessions on the IG platform after the close of Wall Street as well. And look what we got. We got a long-legged doji candle. This to me means that it's difficult for the market to decide exactly where to go. We're currently at 0.1%. It is a better number than expected. It is a better result than expected, but there are headwinds here. Mergers, initial public offerings, debt issuance have all been really subdued this year as the Federal Reserve boosted interest rates to slow the economy down. So I think possibly that's the reason why we've got a slightly worse reaction to Goldman Sachs than we might otherwise have had. Let me take a look as well at Bank of America. Topping estimates for the third quarter, profit on stronger than expected interest income. Let's take a look at the numbers. Earnings per share 90 cents. We've been looking for 82. Profit rising 10% to $7.8 billion. This on revenues up 2.9% to $25.32 billion. We've been looking at $25.14 billion. Net interest income up 4%. We've been hearing a lot about net interest income from JP Morgan Chase last week, from Wells Fargo, all doing really well. The larger the interest rate picture, the larger the interest rate number, the more margin there is in this part of the business. That's up 4% to $14.4 billion. Look at the chart for Bank of America. A little bit different from that we've seen from Goldman Sachs. Not too far away from the recent bottom at $25.46. We're currently trading with the market at 1.2%. We are up on the back of these numbers this morning. It's not blowing out of the park, But Angie, the bottom line is that these banks are producing better than expected numbers. Analysts have been beating down their expectations. I guess that's part of it. But we'll take away that as a positive move, I think, for those two banks today.
Thanks very much, Jerry. Jeremy Nealon there talking about Goldman Sachs and Bank of America earnings, wowing investors at the moment with their top lines. Another company that is spreading some cheer, at least on the corporate front, Johnson & Johnson, raising its 2023 profit forecast. Just checking on the shares there because they're all sessions on the IG platform, and they do seem to be ticking slightly higher there. As I mentioned earlier, the third quarter profit coming in at $1.69 per share versus $1.62 a year ago. And the more important bit is that it's lifted its 2023 profit forecast. And this is coming as the company recorded a $21 billion gain from the spin-off of its consumer unit. Also want to check in on Omnicom for you, because Omnicom is one of those big companies that is key because it gives us a bird's eye view as to how other sectors are actually faring. Omnicom expected to show a rise in quarterly revenue when it reports later. This company, as you know, deals with advertising, and it's expected that the company will say that more people are starting, more clients starting to spend more on advertising. And Lockheed Martin, another one that we are looking out for you, because Lockheed Martin reporting higher third quarter sales revenues on Tuesday. This is as geopolitical tensions helped sustain demand for its military equipment. Lockheed's weapons, such as the guided multiple launch rocket system and Javelin anti-tank missiles made with RTX, have proven critical to Ukraine's war efforts. And whilst we're talking about this, let's stay in the air, because we are also looking out for United Airlines to report. This sector particularly in focus at the moment because U.S. airlines are being urged to act by the U.S. government. Nearly 1,000 U.S. citizens, family members have departed Israel since Friday. U.S. government facilitated flights to Athens are scheduled to continue from Tel Aviv through at least Thursday. United American and Delta, as you know, have temporarily halted direct flights to Israel. And whilst we're on that, I'd like to very much welcome our special guest. Joining me all the way from Texas is Frank Holmes, CEO of US Global Investors. Frank, thank you so much for taking the time to join us. So much has changed in such a short time. When I was trying to reach out to you, we were going to talk about the pickup in travel demand post-COVID, staff shortages, fuel costs, and now investors are trying to make sense of this rising uncertainty out of the Middle East. What are you hearing from your clients?
Well, I just flew back from Amsterdam, and the flights were packed nonstop to Austin, Texas. So I believe that the flights are all very, very strong and robust everywhere except for this region. And it's more difficult for Jordanian Air to how it has to fly around to get to land in the country of Jordan. But I think the most important airlines are really experiencing, like Wizz Airlines is where they're shorting the airlines and going long the Jets ETF is what they call a pairs trade. And Wizz Airlines doesn't hedge oil. So if you have oil prices rising and all of a sudden you can't fly into Israel, in addition to only a couple of years ago, they had to stop flying into Ukraine and Russia, it has a greater impact on single airlines. Americans will quickly adapt. They'll be flying more flights daily to Athens to help Americans to be able to get out. But they won't take the direct flights. El Al is still flying. They have triple levels of security. So I think from that end, they'll improvise and adapt to it. In the whole region, it'll probably impact more so the hotels that are in that region. Airlines are portable. They can go different places, but it's the hotels for tourism in Egypt. Things like that will all of a sudden start to feel the slowdown.
Where do you think you say that they're portable and they can change, where flights are being offered. And I know that your product, for example, has almost 76% exposure, regional exposure to the US. Where do you think this sort of travel demand will adapt and move to?
Well, it's remarkable how fast the airlines adapts, especially using artificial intelligence for luggage, for movement of people, for processing, facial recognition when you land in the US. It's just another level. So I think they will improvise quickly. And what I do see is there's a shortage of pilots, which is most interesting, and they'll find other paths where if there's not flying into Israel, they're going to find other paths to fly to. Americans will still want to start flying from the north to the south as the cold weather comes in. And I believe the same is in Europe, that they'll be flying from Sweden down to Spain and to Italy. I don't think that tourist travel is going to leave. The bookings are still extremely strong. If you want to go and book a premium economy flight, it's basically sold out for going from America flying over to Europe for next summer. And I think that to me is most fascinating. And economy tickets have not come off in any substantial way. So I think the airlines industry remains very, very healthy. The majority of them are hedging. Some are not. We've seen Ryanair make so much money in their hedging program. So I remain very positive on the industry. It's a supply-demand function. We have an issue in Israel, which is really tragic. But the rest of the world will adapt to that.
How about in terms of oil prices? If this does spill across over to the oil-producing nations and becomes a more drawn-out conflict, how will you see that affecting the profits of these airlines, or is the demand enough to offset this rise in fuel prices?
Well, it seems to be a manipulation of supply side. We saw the Saudis cut back 1.5 million barrels, doing everything to try to jack up the price of oil. And these type of conflicts only help Russia, Saudi Arabia, Iran. That's who they really help. So I think that dynamic is quite sensitive in geopolitics. On the backdrop of that, where the demand is actually slow, if you look at Purchasing Manufacturers Index, which is a leading indicator of economic manufacturing, the use of oil and gas for manufacturing of products, it's below. And the worst place in Europe is Germany. China had a bounce up and then has rolled over and has fallen down. So I think the economies of the global economy is very sensitive just to a normal slowdown. And that's because the US has been leading the charge in rising interest rates. And I think that's a much more significant factor to overall global economic activity.
Now, Frank, a lot of the data that we saw in the last few months, and of course, we're waiting on all the other airlines to report and give us a hint as to where demand is headed. Of course, there was this whole post-pandemic travel rebound. However, there are signs of fatigue there. And are you seeing this drop off now? And perhaps could this fatigue, travel demand fatigue, leak over to Europe as well?
Well, I think the biggest data point that I've seen is coming out of Europe, where people, they say, are now searching more for a cheaper flight. But the fact is the bookings are robust and strong. There's no big pricing pressure seeing the travel drop dramatically. I do see still in Europe luxury hotels, 4 and 5 star. The prices are just astronomical. And so I haven't seen that drop off. So I think that we're going to continue to have people are more afraid of another COVID lockdown, so they want to travel. That binge is not to what it was, but it remains very healthy. The airports are busy. So many public companies are actually, airports are public companies. Paris, de Gaulle is public. Bangkok is public. Japan is public. In Mexico, there's 3 airports that are public, listed on the New York Stock Exchange. they're all doing exceptionally well.
And Frank, just on that note, if demand does start to falter, do you expect the airline sector and the travel sector just to stimulate demand via pricing, i.e. cutting pricing?
Well, you don't have the competition you had pre-COVID, where there's so many pilots. So many of the pilots now are at retirement age, and the generation of new pilots coming on stream, the criteria for you to become a pilot, to fly a 747, they have thousands of more hours of experience in flying. They used to get them from the military, from the Air Force. The challenge now is that most of them are now flying drones. So they really aren't flying passengers and flying in the sky. So the airlines are spending a lot of money trying to train pilots to get the necessary thousands of hours of experience of flying. So that's going to take a long time before you get this huge increase in the number of pilots, which then allow airlines to look for new paths to go and compete. And that drives down prices. If you have a supply shortage of pilots, then the airlines actually have pricing power as the world continues to have babies and population continues to grow.
Right, thank you. We have to leave it there. Thank you so much for joining us, Frank Holmes, CEO of US Global Investors. Now, turning to another topic which is connected, US President Joe Biden is set to visit Israel on Wednesday. This is after Washington said that Prime Minister Benjamin Netanyahu agreed to let humanitarian aid reach the Gazans. Just wanting to show you the price of oil because oil steadied after sliding more than 1% on the day. We will keep a close eye on this for you. Just checking in on volatility now to see whether there's been any reaction to that recent retail sales figure that was slightly stronger than expected. And volatility is, interestingly enough, ticking ever so slightly higher, not by much though. IG's chief market analyst Chris Beecham has been taking a longer view of the VIX.
Recent outbreak of conflict in the Middle East has understandably added to investor nerves about where we go from here. We came into October with a rising VIX, volatility index, the fear index, if you like, was surging from multi-year lows, really. So it's unsurprising in one sense the markets have seen a burst of volatility. But the VIX has paused in its ascent over the past 2 weeks or so, despite obviously the movements we've seen in recent sessions, which might suggest that even with concerns about the spread of the conflict and earnings season now upon us, it looks like maybe things are beginning to quiet down on the VIX front, which means historically strong seasonality for US stocks like the Dow and the S&P might well take over from here.
Thanks very much, Chris. Now, before we go, let's have a last look at how the market is looking as we count down to the open for you. And we are seeing US stocks indicating extending their losses after data showed a stronger than expected rise in monthly retail sales. This, of course, fueling concerns that the Fed could keep interest rates elevated for longer, with another hike also on the cards. So until then, that's it for this edition of Beat the Street, the show that follows all the trading action, helping you position yourself ahead of the opening bell. For more trading insight, do follow me on @AngelineOng on Twitter. This is IGTV.